Hello and welcome to Idea to IPO. I'm Jason Putnam Gordon, an emerging growth and venture capital attorney with K&L Gates LLP. I'm based in San Francisco, California, but I work with clients all over the world. K&L Gates is a fully integrated global law firm with over 40 offices on 5 continents with 1,900 attorneys. We have a fantastic panel today. We're going to discuss what to expect in the rest of 2022 and beyond as it relates to venture capital. Our panel is Nuno Gonçalves Pedro, who is a managing partner and founder at Chameleon, Ephraim Lindenbaum, who is the managing director at Advanced Ventures, and Bill Reichart, who is the general partner at Pegasus Tech Ventures. All of these folks are returning champions, and it's going to be a great conversation today. Before we begin, I'd like to inform the audience how today's program will run. So the panel will talk for about an hour until about 1 o'clock Pacific time, at which point we'll take questions. If you have a question, please use the Q&A function. We'll be monitoring that, or I'll be monitoring that in the background. If you want to chat with each other, you can use the chat function, but I and the panel by and large will not be moderating and monitoring that. Today's session is recorded, so long as you've registered, in about a week or maybe less, we'll get you a copy of the session. So if you miss some or all of it, that's great. That also means, of course, that the folks who aren't attending live, we're still thankful and happy that you're here. Again, please fill out the audience survey. One final comment, I am also running all the tech in the background. So if you see me looking away or typing, it's not because the panelists aren't interesting, it's because I'm working on that. So please forgive me. With that in mind, maybe we'll let Bill Reichart start, he can talk a little bit about himself, his background, his fund, the vertical, and what part of the life cycle of venture-backed companies he works in, as well as contact information. Bill?
Sure. Thanks, Jason. And thanks, Rob, and to the Idea to IPO group. Always great to be part of one of these sessions. I enjoy it and love to come back, primarily because I learned so much from Nuno when I'm on a panel with him. That's my main objective here. So in any case, in terms of my role and my background, as Jason mentioned, I'm a general partner at Pegasus Tech Ventures. Pegasus is a global venture capital firm with headquarters here and offices around the world, investing in a very wide variety of technologies and businesses, primarily focused on enabling our limited partners that are over 30 multinational corporations find emerging technologies that are of strategic interest to them, with the idea that we can then partner our portfolio companies with our limited partners to accelerate the success of both. So it's a win-win-win strategy for venture capital, very different than a typical Sand Hill Road firm in terms of the degree to which we engage with our corporate partners to accelerate the success of our portfolio companies. But I come to this from a long background in Silicon Valley, long ago and far away. When I was a student at Stanford, I started my first software company, and that got me hooked on Silicon Valley. I was a co-founder or restarted a couple of different companies, 4 different companies, 2 of which we wound up taking public before I became a VC. I then started a venture capital firm with Guy Kawasaki and a few other people called Garage Technology Ventures, which was designed to try to help as many entrepreneurs as we could around the world connect and plug into the venture ecosystem through an entrepreneur-friendly model of reaching out to entrepreneurs and providing education and support. So a couple of years ago, Pegasus Tech Ventures acquired Garage, and that's how I got here today. So in addition to being a venture fund, we also run a global competition called Startup World Cup, which is right where, how do we do this right there? Okay, right. Startup World Cup is the biggest and richest startup competition around the planet. We operate in about 70 regions around the world and have a grand prize of $1 million and another 1 or 2 million in prizes as well. So any entrepreneurs out there, pay attention to Startup World Cup, sign up for a regional competition near you, and you have the opportunity to potentially win $1 million prize. So enough about me. Let's let the others talk. Okay.
Well, we're delighted to have you here, Bill. Thank you so much for your time. Looks like F's mic is already open, so I'll let him go next.
Great. Thank you so much, Jason. Great to be on a panel with Nuno, Bill. Rob, thank you. Always great events from Idea.io. So my name is Ephraim Lindenbaum. I'm the managing director of Advanced Ventures, a Silicon Valley-based venture fund, and I'm a recovering entrepreneur. So I started on the other side of the Zoom where many of you folks are starting companies and growing companies. I started a company when I was quite young, about 18 years old here in Silicon Valley, grew that company for about 11 years, got ready to file our S1 to go public in the dot-com boom, and were acquired by a very large player, big dot-com flyer there. Spent a little bit of time as their chief strategic officer, and then came back to the Valley. And it's somewhat binary as an entrepreneur. If you exit here, you either start your next company or become an entrepreneur, become an investor. I jokingly say I didn't have any great ideas, but really, it was a great time to start a venture fund. I partnered up with both a female co-founder as well as a former investment banker, and we formed Advanced Ventures in 1999. So we've now invested through 4 successive funds. We're on our technically our 5th managed co-fund now. We invest across technology, health, and wellness. As you might imagine, over the last 22 plus years, it's evolved quite a bit. But our categories are traditional tech, but very much today, digital health and financial technology. We're very active in the food and agriculture category. We've got leaders like Alpha Foods, as well as Myco Technologies doing plant-based meats, CPGs, et cetera. So we're very much into an altruistic as well as an investment strategy. We typically invest in the early stages of a company. We would historically say that we were sort of the first seed, et cetera. But, as venture has really grown and broadened out, we're really at that pre-Series A, Series A stage of a company where there's already a product, there's already a formative team, they're starting to generate both revenue and customers. So we're a little further down the pipe than most folks are, but we always invest in syndicate. We often will lead, but typically we'll work with other VCs in the Valley.
Well, wonderful. We're glad to have you back and joining us for this panel today. And Nuno, last but certainly not least.
Thank you. Well, thank you for having me again. We've done this before in some other options, like with Bill and F and with you, Jason. And Rob, thank you for having us. So I am the co-founder and main partner of Chameleon. We are a venture capital firm. We're not Chameleon VC or Chameleon whatever. We're just Chameleon because that's how we run. But we are actually a venture capital firm. We do mostly early stage investing, Series C, Series A, anywhere from $1 to $5 million first check in, and up to 10 million over the lifetime of the investment. Multi-geography, although we are based in the Bay Area and we have an office also in Portugal. 2 claims to fame. 1, we have something called #KIN, which is our advisory, entrepreneur in residence, whatever network. So instead of just calling them something, the poor people that work with us and work with our portfolio companies and LPs, we just call them KIN, #KIN. And so we've productized the model of engagement and how we work with them. And then the second piece is we are quant and tech augmented. So we actually have a quant and tech team that is larger than our deal team that basically is product managed by yours truly here, and basically comes up with our deal sourcing, due diligence, portfolio management tools that help us identify companies and do a variety of other things, which is also very unique. This is my second VC firm because I'm a masochist. My first VC firm was Strive Capital, and we actually did a subset of what we're doing today using quantum tech, very focused on mobile apps. And I personally focus more on consumer investing, both hardware and software, as well as horizontal software as a service. So I've invested in companies like DraftKings, Robinhood, Verta Health, Gusto, App Annie, now Data.ai, and a few other companies that you might have heard about. I've been in tech for 26 years. I am still young, but I started working through college. I'm an engineer by background, product manager, sold to the dark side very early, became an operator along the way and a growth operator around strategy, product management, corporate and business development, and had a stint with McKinsey for 6 years that I can't quite explain because I was their client before I joined them. I was a senior expert and member of their leadership team. And anyway, it's a long story. I enjoyed my time at McKinsey. I would just say that. after the first year, I enjoyed my time at McKinsey. The last 5 years, I enjoyed my time at McKinsey. So that's basically me.
Well, fantastic. It's great to have you back. I think I'll also note, although I won't hold you to it, Bill and Nunu, I think you both were on the panel that we did back at the beginning of January in terms of what to expect for 2022. So it'll be interesting to sort of get caught up on what has happened in the last 6 months. But before we do that, I want to just take a look and see who's in our audience. I'm going to close the poll at this point. You've got, let's say, 5 more seconds in case any attendees didn't fill it out. And so at least watching live, because again, this is recorded and will be distributed, we've got nearly 40% of the people from the Bay Area and close to almost 35% of the people from elsewhere in the US. So we've got a strong US and also North America contingent, a few folks in Europe, and then a few folks in Asia. But again, many times Asia, Africa, and Europe catch up and watch us afterwards on a time shifted basis. And then in terms of the composition of the live room today, we've got 40% are first time entrepreneurs, 20% serial entrepreneurs. We've got almost 20% in an early stage company, and we've got a couple folks from growth stage companies, and we've got close to 10 or 11% who are venture investors. So we've got a great composition here. If you're not joining us live, we're still happy to have you. And let's get started with the conversation. And maybe I'll allow, or we'll have Nunu catch us up as sort of what are some of the things that have happened in the last 6 months from the beginning of January.
Well, first and foremost, I told you so. I think Bill also told you so. So we were both right. There was a bubble. It burst. And it might not be done yet. It might still be bursting. So what's happened since January is the unavoidable burst of the bubble. On a more serious note, I was actually, I have a podcast, which is decipheredshow.com with Bertrand Schmidt, the founder of App Annie. And we were actually looking, we did 2 episodes on the bubble last year, and we launched them at peak bubble, right? So he was checking, actually, the second episode was launched the week of peak public equities in the US, right? So I was like, okay, we got this right. I think that's the first thing, that, you know, we were in a market that was totally skewed towards, in some ways, tech companies. It was totally skewed towards startups. They were sort of commanding and defining the rules. We were having a lot of what we call in venture capital party rounds, where, you know, the entrepreneur sort of sets the terms and everyone has to come in or you're out, right? And it's sort of unavoidable that at some point in the cycle, the world had to go the other way around, right? There weren't that many amazing companies out there that needed to get funded, right? So there was maybe too much stuff going on. There was too much capital in the markets. Us venture capital investors had too much capital to deploy as well in some ways, or at least some of us. And so at some point, the game of chairs, I think Bill has called it the game of chairs in the past. So I'll use the words from him and we'll give him the trademark. It had to stop, and some people now actually don't have a seat to sit down on, right? Because their businesses don't sort of make sense. And so I think the work we've done over the last, we've been very, very blessed that in the last 4 or 5 months, our previous portfolio companies really haven't run into any dramatic trouble. I've had one company that went through a complex situation, but they got bridged. But most of them have actually, lo and behold, have been well. Obviously, the companies we've currently been investing in the current fund, it's still early in the current fund, so they're still doing well. But the discussion has moved to, now let's start talking about runways of 24 or 30 months, right? It's not 12 to 18 months anymore. So runway, the time being of that you as a startup have until you run out of cash, right? If you don't assume any major shifts in terms of revenues, et cetera, right? So the discussion has shifted to that, right? You have to have a plan B and a plan C. You have to make it work with what you have. But at the same time, the discussion has also shifted towards opportunities. There are businesses and startups that are doing extremely, extremely well. And so in the micro environment that I live in, this is now the discussion of, you know, sadly, there's a lot of layoffs, right? You know, we've gone from the great resignation, sadly, to the great unemployment, and it's going to be worse. It's not going to be done yet. And so in that environment, it's actually now easier for some of these startups to hire talent that maybe in the past was difficult to hire. So there might be opportunities to hire people. There might be opportunities that, some startups are in the process of failing, but they have great teams, and maybe, they can be acqui-hired, or they can merge, or they can be brought together. And so again, every time there's such a very challenging play and you have to think through, plan B, plan C, how do you make your money work, knowing that it might be difficult for you to raise within the next year to year and a half. At the same time, your business may be doing very well, and there might be incredible opportunities for you to expand and to really go into new markets, hire amazing people, buy companies, etc. So it's sort of a tale of the haves and have-nots, but in some ways, that's how we are talking to our startup companies and to our portfolio companies at this stage.
Fantastic. Bill, what are you seeing?
Yeah. So I'm wishing we had the transcript from 6 months ago, but as I recall, we knew that we were in a bubble and that there had to be an adjustment, and I know we were hoping it would be a orderly. I think this is the phrase we use. It would be an orderly adjustment as opposed to a meltdown. And so far, in fact, I think it has been relatively orderly in terms of the stats, and some of the numbers seem like crisis numbers, but in terms of bloodbath, I'm not seeing bloodbath, at least not yet. And so I think the good news is that and this is like a dirty little secret I don't really want the entrepreneurs to hear, is frankly, we're delighted that this has happened because, we knew it was not sustainable. We knew it had to happen. And it was, again, frankly, the VCs were incredibly frustrated that it was such a seller's market, and that, that things were so overpriced. And if you wanted to play, you had to pay up. And it was just painful. It is, while this is also painful, it's a necessary adjustment. And now the question is, how disruptive is it in terms of, the phrase bloodbath? But the good news, again, is the venture world has so diversified, in this cycle, that it's not so narrowly sector dependent as it was, particularly way back in the bubble. Way back in the bubble, it was a total bloodbath because everybody was a .com, and the whole .com, was wiped out almost, right? With very few exceptions. In the meltdown, it was a global catastrophe. Right now, the good news is that we're coming out of COVID. There is, broadly speaking, a lot of money sloshing around. And there is a huge demand for innovation. There's this, extraordinary demand for innovation. When the meltdown happened, we needed innovation, but everybody was paralyzed. It was, so people aren't paralyzed now, fortunately. There's a lot of pain and suffering associated with inflation and with some of the stock market pricing. The IPO window is closed. That makes people upset somewhat. But I think in the grand scheme of things, it's not terrible whether you're an investor or you're an entrepreneur. So we're hoping, absolutely Nuna's point, that it's going to be harder to raise money. The pricing, there's going to be a lot of down rounds. You're going to have to suck that up. But there's lots of money out there. There's lots of demand for innovation out there. Globally, it'll be interesting to see sort of how the venture ecosystems adjust. Silicon Valley will certainly adjust, but most of the growth in the last 2 years in the capital that came in from the outside. The late stage unicorn chasing, capital that came in, sort of the core venture capital industry, I think, is in very healthy shape. And so again, classically, good companies, good entrepreneurs with with compelling value propositions, I should not have to worry too much. They just have to work a little harder.
F, I'm
Well,
sure you've got some
yeah,
thoughts.
so I'm somewhere in the middle, similar to Bill. I've been through a lot of these, both as an entrepreneur and then as an investor. I think the jury is still out. I think we may be in a much more cataclysmic situation than we all sort of know at this point. The next, I think, 12 months are really going to define that. I'm much more concerned that we're looking at a early 90s, mid 90s Japan situation vis-a-vis a dot-com collapse or some other model, much more of a catch a falling knife. We have a scenario right now, unlike the dot-com collapse or even the late 2Ks recession, where we have an inflationary bubble attached to a recessionary bubble, which is very, very challenging, right? So what that means is two sides have seized up, right? You've got a capital markets problem and you've got a free cash flow model as well. And that's a real problem that we're seeing out there. I mean, as of today, my assumption is the market is about to close. This will be the worst, half year in 52 years in history of the stock market. So, when you start looking at that models, the real seize up and, having been through this so many times is actually going to happen much deeper and longer downstream, right? Right now on the venture side, all of the venture funds, many of us are really topped off from such a healthy stock market over the last couple of years. 2 and 3 years down the road, it's going to be a bloodbath for VCs. We've already seen venture numbers start to collapse. So, what we will see are larger funds start to pull back to conserve. Smaller funds are going to have a real big problem, and this ultimately will affect the entrepreneurs. What we like to look at is flight to quality. And I think at the end of the day, quality is going to really change here in a couple of different ways. This to me is mirroring the 08 cycle where you've just seen the public market exit window for venture, startups basically move into a 5+ year, extension cycle, meaning that where if you were in the IPO window today, you may be pushed out 4 or 5 years. We can look to the Facebooks of the world that got jammed behind the 08 recession and didn't go public until 2012, right? So you've got a lot of issues at hand. More importantly, the interest rates have gone up in a way, and more importantly, the private capital side of the interest rates have really gone up. We've started to already see the loan sharks come out offering very high interest loans to avoid down rounds with startups. So, this is really, potentially turning into a very, very challenging situation. And frankly, on both sides, I mean, venture folks are going to have a really hard time in the next 24 to 36 months raising their next fund. The returns aren't going to be there. The exits aren't going to be there. And the plethora of public market free cash because of the gains is not going to be there, right? The hedge funds aren't going to be floating around. The family offices have tightened up already. So, this is a much more challenging sort of snowball effect. And, we're going to see this over time. Now, what does an entrepreneur do today? Well, I think the first thing we have to look at is, a real, deep look at your own business, right? Is this business going to make money? Is this a fundamental model? The go get customers, go get traction, go get these things. In my opinion, within the next 12 months, words like that are going to be gone. Are you making money? When are you at break even? How quickly that's the case? The key words are going to be, is this a must-have or a nice-to-have scenario? Because must-have is where we're at. There are core areas that we invest in the ag tech and the automation space, in food, et cetera, where big problems are getting addressed. Areas like hospitality, the restaurant industry are, out of headcount, right? These are areas where you can save money. You've got a need set that's going to occur. Enterprise software that isn't solving an immediate challenge is really going to have a challenge. Same with digital health. The FDA is very backed up on therapeutics, even backed up on 510 digital. Everybody's going to get stretched there as well. So, I think there's going to be a bloodbath in a lot of categories that are going to, need to stretch, as Bill and Nuno said. This may be 24 to 36 months or more before you want to take a round as a startup. And the question that they're going to ask when you start that conversation is, are you cash flow neutral? Are you cash flow positive? Are you solving a really critical problem that in the worst economy in the, in known history, are people going to write check for? I don't mean to be the bearer of bad tidings, but at the end of the day, I mean, you can look back to the '08 cycle, look at what Sequoia did. They raised the pirate flag, they screamed bloody murder. Was it that bad? Hard to tell. But at the end of the day, this has gone from healthy paranoia to manic paranoia that the startups need to have in order to make it through this. There's going to be a lot of bloodletting, not just in the Valley, but I think more so in these startup hubs that are further and further away from the central, core of the venture industry, right? The smaller venture upstart areas of the country, whether you want to look at, Minnesota, even some of the biggers that are around Chicago, even Austin, again, they're going to get crushed, because the big funds aren't there.
And maybe let me just pick up on this from F, because I think this is important. For example, we were actually feeling that deals in the Bay Area, this is even during the bubble, deals in the Bay Area were actually less bad in terms of pricing and valuation than deals in Europe.
Agreed.
We were looking at deals in Europe that were silly. There was so much capital put by, government, states in Europe that the valuations were silly and companies were getting funded. That I was like, why are these guys getting funded? So in some ways, the bubble bursting in other parts of the world, even not just in other parts of the US, might actually be more acute than here, right? And again, this is quite different from 2000, right? Because in 2000, it was a lot of Silicon Valley, right? There was the nuclear winter here. And obviously it had ripple effects into telecom and to tech around the world, but the startup ecosystem that was really destroyed was sort of here, right? Or that faced the wall was here. And I think right now it is really more systemic. It's really more global.
Interesting to say. I would just, I guess I'm a little more optimistic in that regard, just because I do think that in this cycle, the strength of ecosystems around the world became a little bit deeper and firmer than it was in previous cycles. And so, while absolutely, everybody's going to take a hit, I don't think we'll see a sort of clearing out of all these ecosystems the way we saw in previous cycles. And so I guess I have some optimism that the breadth and depth of the sort of innovation economies around the world is a little bit more resilient than, and that the pain of this economy is not going to be as bad as compared, particularly with the meltdown. But I guess we'll see. Okay.
If I could, I would like to maybe just interject a couple sort of rip from the headlines data that I found, because I think it maybe sort of underscores everyone's point here that, we're sort of maybe beginning just to see what's going to happen down the road. Is, there's always a lag, especially with private companies. It's difficult to get market data in real time. And so, sort of the best data we really probably have is almost sort of Q1, which is really not, not that far. Not that long. Q2 is not even what closes today, right? But we're not going to see that data for a little bit. So some of the things that I've pulled in preparation for this include, the average US Series A for the first half of 2022 was $20.4 million, which is down 20% compared to the second half of 2021. But actually, those amounts are basically, and talk about the valuation here, no, that must be the amount that they raised. The amounts are on par with the first half of 2021, and that's well above the $16 million 2020 average.
Yeah, I mean, I think the bottom for us is going to be better than 2015, and 2015 was pretty okay, right? I mean, maybe it will not be evenly distributed, and there's a big difference between coming up and going down. But again, I mean, yes, it's not going to be 2020, it's not going to be the last 3 years, but compared to, I mean, I'm hoping it's true that the bottom is still better than 2015, and 2015 wasn't terrible, right?
Yeah,
I don't think so. I don't think so. I think we're going to go, this is going to get worse. This is the beginning of getting worse. It's not the end. It's not the end of the beginning. It's the beginning of the end. Yeah,
but Jason's point is, right now we're still at 2021 values, right? So
That's what the data would appear to sort of indicate.
Right.
Yeah.
And so God bless, we go down another 20%, we'll be at 2019. And so I'm, but again, the momentum when you're going down is very, very different than the momentum and feel when you're going up. So it doesn't matter where the absolute number is, it's the direction that counts. And that's, to your point, it's going to get worse and the direction is not going to get good. I think we all agree on that. It's just a matter of how bad becomes. And I'm surprisingly the optimist here, I guess. I don't know.
No, but this is
Well,
not bad for buy side. This is not for us venture capitalists, as you mentioned, Bill, right? Because now the power moves back to us, right? and that's the reality, right? Now, we had companies that were raising through the bubble, and they were very arrogant and complex and whatever. And honestly, in our minds, we had passed on a few of these companies. In our mind, obviously, we communicated in different ways, and now they're back at the table. It's like, oh, can we talk? And we're like,
Right.
not really, because we actually don't believe in your business, right?
Yeah.
But it's I think that change of power is happening already, right? And we're going to see in the next few K&L Gates and all the other law firms that publish the terms and are they changing quarter on quarter. I mean, it's going to change for sure. And everyone is like, oh, we're not seeing it yet. Yeah, you're not seeing it because it's still the beginning.
There's a
right?
lag.
It's
Yeah.
gonna happen. It's gonna
Right.
happen.
Right.
Yeah,
And
I mean,
we are
I
seeing
think-
it sort of in the later stage rounds. It sort of seems like that, right? There are fewer mega deals, like $100 million plus raises that are happening. They used to close like five a week. We're kind of just not seeing that. But it seems like the lag, works in reverse order, right? Late stage.
No, I'm seeing it in early, right? I mean, pre-seed. I mean, people having difficulty raising pre-seeds, right? I mean,
Well, again,
angel investors stepping back, right? Angel investors stepping back, saying, you know what? We already were
The
having this from
Q1
the
data
beginning of
was
the year.
okay on that, but it
No,
would
but
be
we were-
interesting. But it seems like it feels
but we
like
were
in the
seeing,
Q2
Jason.
it's starting to go down. I
But
agree
Jason,
with
we
you.
were seeing this from the beginning of the year. We were seeing a bunch of firms that shall go unnamed, even doing late stage term sheets,
Yeah.
reneging on their term sheets or renegotiating their term sheets,
I've
right?
seen
Which
that
is sort of like, I
as
mean,
well.
that's like
Yeah.
blasphemous in the VC world, right? You don't do that
That's
stuff, right?
Silicon Valley, right? No, you don't. Right. But on the other hand, when everything was going up, we would hear there were plenty of entrepreneurs who would say, how come the statistics that keep getting reported don't seem to apply to me, right? I mean, everybody was saying, oh, it's so easy to raise money and it's so easy to get a 20 million pre-money on your pre-seed round. And that was, that was in the press, it was in the statistics, but for most entrepreneurs did not in fact have that experience. And it wasn't, kind of walking down the street, getting money thrown at you from most entrepreneurs. And so, yeah, I mean, it'll be, there is this shift and it will be for more and more entrepreneurs, it will be harder and harder. But I mean, again, I think post-COVID now, so many more parts of the world have come back. And so hospitality, transportation, real estate, all of those which got wiped out by COVID for a couple of years, they're all back. And so, there's the broad base of innovation opportunities has, reestablished and is getting broader and broader. And so, and again, there's a need for this innovation. And, to both of your points, if you have a compelling offering that is a must-have, business is continuing. We're not shutting down quite the way we did in the meltdown. And so there will continue to be business and there will continue to be problems that need to be solved that'll get funded. Again.
Yeah, not to be pessimistic though. I mean, I think some of the aspects of this are sort of a much longer drag cycle, right? The impact of raising interest rates will take up to a year. So like I said, jury's out, in my opinion, for another 12 months, how bad it goes, right? So, I think one of the bigger issues are, companies out there that may have notes that may readjust, companies that have credit lines that are going to get bumped. Those are the unintended consequences that we didn't see in prior collapses, right? I mean, .com collapse was, just wholesale slaughter per se. But I think this one is very much a catch a falling knife kind of scenario where some will get blown out initially, then you'll go through phases, right? And ultimately I agree with Bill and Nuno. Great companies will survive, right? But if you're not making money, if you're not cash flow neutral, words like that will be the opening salvos of every venture meeting going forward. And I do really believe that these hubs outside of the Valley, outside of the stronger venture ecosystems, are really going to be under a lot of stress, right? There isn't the depth of capital there to sustain, right? Here, you can, if you're a great company, you're making money, you've got tons of customers, you're going to get a haircut. Maybe you're going to end up shiny bald with a down round, but you're going to be able to find some money somewhere, right? If you're in the outer lying regions, there's only so many sources of capital. And, really one of the things is, we really do sort of, circle the wagons in this environment. And, really, I mean, we've seen the resurgence of, Austin for the 10th time or something now. I'm real concerned about that. Areas like that, areas like, some of the Midwest hubs that have kind of rose up are going to be Mid-Atlantic. I mean, areas like that are going to be really, really challenged from a startup capacity, because once you get through that first 5, 10, 15 VCs in town, you're done. And, coming in as a carpetbagger to the Valley is tough enough, let alone, when we've battened down the hatches. So I believe it'll be a much broader based slaughter. Do I believe the Valley will tend to succeed? It's very interesting. I think some of the winners of this are actually tech companies. Actually, I don't think venture folks are winners in this. I think big tech is going to be a winner in this, because the headcount at Google, they're still hiring. Apple still needs to hire. Facebook's going to need to hire. And they were having a real hard time filling slots. And, when the venture ecosystem starts to implode, the decision of, that VP, do they go to a startup or do they take a much more, certain outcome type job? These are the conversations I'm hearing in the Valley. And that's going to really change the environment as well. So there's a lot of pieces moving right now. How they fall is going to be challenging. Could be Japan. We could pop out of this thing in 18 months if the Fed does its thing and be in reasonable shape.
Okay. So then the question is, Jason, everybody talks about how great companies are created in crises, right? So what are the crises that we're about to go through that will enable great companies to be created? I mean, the classic is sort of, the Airbnb story, right? That,
that they sold.
Right.
They had to sell whatever it was, the cereal
Right.
boxes and stuff to survive. I think F has already alluded to a few things. I think the notion of runway unit economics coming up earlier in the life of the company and thinking through things much earlier, right? You sort of can't get away with burn rates that will get you out of business in 12 to 18 months, 30 months plus might be a must. I think that's sort of just sanity check. So that type of cash crunch of not having cash available. Markets are shifting. I mean, to your point, and I think it's well taken, some markets are coming back, some markets haven't fully come back, right? And if you're still running on markets that haven't come back or markets that are going to be affected in some way, I mean, you obviously need to re-energize and rethink your strategy. It's very funny because a lot of startups have difficulty doing that, in particular in early stage. They're like, this is the market I'm in, this is where I'm going to go after, and my market's doing really, really well. Mm-hmm. And Bill and I have been on a bunch of discussions on this, even in the last few years, where it's like, well, just be cautious with this, because there are some markets that are doing really well today, but it's a fad. And there are some markets that are really doing very well today that will stay to stick. And now the rubber is hitting the road, right? In some ways, we are now seeing markets that were doing extremely well through COVID that are now maybe going back to a new normal, right? Which is not as good as they were during COVID. It's probably better than where we started this thing in 2020. I look at gaming, for example. Gaming for me is a good example of that. There are areas of gaming that are definitely much better than we were in 2020, but they're not at a height anymore, right? So you can't just ride that wave full throttle anymore. So I think market assessment, strategy definition is really important. Cash is king. I mean, cash is going to be king going forward. And the final thing I would say is, to your point, F, you were making this point as well. be thoughtful of who's backing you and not backing you. And it's not just that the venture capital firm has a lot of assets under management or not, is, at every point in time, make sure that the venture capital firms are with you. Are like, would they still put money in us today? Do they still think that we're doing good progress, right? Do they still think that we are good guys, right? Because I see a lot of entrepreneurs like, oh, I'm running out of cash in 4 months, but my guys are going to bail me out. It's like, have you had this discussion with the guys that are going to bail you out? Because they might not, right? Just to be clear, right? They might not put money in the company, right? They might let you fail. So again, these are discussions that need to be had.
Yeah, certainly. I mean, I think, the key words in my mind is a shift from strategic to tactical right now. When you're a startup founder and you're coming up with your idea, you're talking about your market, your go-to-market strategy, all these other elements. There was, I think, a large sort of strategic vision that was able to be sold in sort of boomer times, right? This is now a tactical blocking and tackling kind of scenario, right? I mean, when do you make money? Are people willing to pay for your product? This is no longer getting customers on board. This is getting customers that pay you on board. So I think it's always good to have this. I think there are going to be categories, that are still hot. I mean, agriculture, food, elements like that. There's a lot of pent up demand in some categories. So I think a lot of it comes down to shifting and, looking at an entrepreneur that may have tried to, bullseye themselves into enterprise software. May need to start rethinking, is that something that goes into some of these other categories where they have problems, looking at the real challenges out there versus trying to, just trying to create a better solve, right? So it's kind of the model that we look at is, brave new world versus better, faster, cheaper, right? We've gone from, in my opinion, a bit of a brave new world cycle to a very much better, faster, cheaper cycle. And to Nuno's point, that's a lot of it is positioning for a startup. A lot of it is how they think about it, how nimble they're going to be. And I agree with Bill, innovation always wins the day. It's just, how much better does it need to be to win the day,
Yeah. Yeah, I mean, I think right. We're please, if you're in the food delivery business, please, figure out something else to do. So these things that had a tailwind during COVID. To I guess Nuno's point, that's not good enough anymore. But there are some things that are emerging that are huge, strong, long-term trends. And that we saw partly from COVID and partly now in this new world that are really, really interesting opportunities, I think, for innovation. And started with the whole food ag thing. That's clearly going to be big. We're seeing sort of lots of diversity in that space around going beyond the impossible, I guess, and there's beyond meat, right? But more than just plant-based substitutes, there's a whole bunch of stuff in the global food economy that represents an opportunity other than delivering meals to the last mile. But the other thing that has happened in this cycle that is, everybody's been aware of, but I'm seeing a tsunami of innovation happening on the life science, genomics, health tech, med tech side that partly got driven by CRISPR. We had the genomic sequencing, we had CRISPR, and that has taken 20 years to sort of build momentum. But there's amazing stuff happening in that space on top of the whole COVID, telemedicine, telehealth aspect that's changing the whole healthcare system, as well as the life science and medicine system. We're getting just all sorts of amazing, interesting, deep tech, deep science things, innovations that are popping up out of universities and out of research labs around the world that are just really interesting, inevitable innovations that might take 5 or 10 years, but that's our time frame, right? That's what we're looking at. We're not looking at next year. And then obviously the whole climate tech question is maybe controversial. It'll be interesting to see, but I don't know a single Global 2000 corporation that doesn't have this discussion at the board level about what are we going to do about our carbon footprint. We have an obligation to do something about our carbon footprint. And that's, generating a lot of energy and angst. I don't know how much innovation it'll generate, but there's certainly a lot of pressure in that direction that has been reinforced now by this resurgent oil price thing. And not to get into politics, but as long as Putin is around, the price of oil is going to be, overpriced, I think. We'll see. We'll see how that goes. But so I think there are a whole bunch of things that are emerging in this environment that represent some really interesting opportunities that are going to attract capital, that are going to attract innovation and innovators that represent, really interesting possibilities.
Can I just say one final thing, Jason? I know you want to interject, but it's, there was the famous Sequoia deck that now came out, and they have, I didn't know there were racers there as well, but they have the Ayrton Senna thing, right? You cannot overtake 15 cars in sunny weather, but you can when it's raining, right? I'm a racer, and I'll give the opposite analogy. I think that analogy is very correct. We've talked about it, about the logic of opportunity, the logic of, there's so many things that are out there that you can conquer. But sometimes just staying on the race, you get a podium, right? And so this literally just happened to me 2 weeks ago. The guys in my category at the track, two of them were fighting each other. They took each other out. I got a third place. The only thing I needed to do that day was to stay on the course. I had to finish the race. There was nothing else I needed to do that day to get a third place, right? And so again, sometimes it's a bit of balance on both sides, and you need to know which side you're on, right? On the side that you can overtake in the rain, it's fine because you have plenty of capabilities and skills, i.e. you have plenty of cash, your business is growing, whatever. You can be the aggressor, so to speak, or do you need to be the Nunu, right? Not the Ayrton Senna, and stay behind, like, I just need to finish this race and I'll get a podium. And I just need to go through the pain of cash cutting and getting there. And at some point, maybe something will emerge that will turn my business around, right? And knowing that and knowing where you are is very important.
Yeah, I mean, I generally agree with that. I mean, I think, to an earlier point, being able to realign thinking around the focus of the company, I think is really important. Where there was kind of a thirst over the last couple of years for, innovation and trying to gain, generally, streamlining, efficiency, stuff like that is really going to turn to a hardcore cost savings dynamic, right? And as an entrepreneur, if you can't make that economic case that, adopting your tech, buying your product is an ultimate cost save, not just an efficiency gain, but can translate down into real dollars and cents, I think that's mission critical. The good entrepreneurs we're seeing right now are already laying off a lot of headcount. They're already dropping price on product. They're already out there, retooling their go-to-market messaging around dollars saved, your payback, your ROI. It's not just, it's nearer and nearer term, right? Shaving down product, bundling things together so that you're, just getting the customer on board. Don't try to sell them 10 modules, sell them the whole thing and try and get maximum, savings for the customer early on, because, gaining a customer has just changed dramatically, right? Owning a customer through this cycle and just keeping them happy and keeping that cash flow coming in from a customer is the battle right now. I mean, this, you're the looky-loos, the entrepreneur, the enterprise side, where a mid-tier with, purchase authority to 10, 20, thousand a month, for software, and even 100,000 for other products, that's gone. Those things of, testing out something really, really tough. So, I agree that, if you just stay the course, you already have to be on the track, to Nuno's point, right? Your engine has to be running. You have to have enough gas in the tank. You have to be able to make it to the end, not just stay, right? So that's part of it. And I agree with Bill. Innovation is there, and entrepreneurs need to be looking for where to innovate, right? Tesla was the #1 selling vehicle here, pretty much, new vehicle over the last, quarter or two. I don't remember exact data, right? There is a ton of stuff that is going to fall out of that camp, right? That people haven't thought of yet. I mean, there's a lot of elements that have changed in the ecosystem. I'm less maybe bullish on the digital health category, honestly, just because the hospital folks seem to already be forgetting their COVID woes. But, to a large degree, the organizations like FDA on the therapeutics and the regulatory is just, they're a bit of a mess. But I think finding the seams is the art. Great entrepreneurs, can really turn this into a good opportunity. We saw that in 2008, and I think that's kind of where we're at right now.
So I want to take this opportunity to disagree violently with Nuno on this one. And so I do agree that there's some virtue in figuring out how to just stay in the game. Because if you can just stay in the game, perhaps you can survive. But I'm also gonna suggest that maybe the answer is get off.
Just to be clear, when you're racing, just staying in the game is still you're getting G's left and right. So I wasn't saying you're going to drive at 5 miles an hour, right?
I know. I get it.
That's why I used the racing analogy, right?
I'm not saying it's easy to just stay in the game. Where I'm going with this is the classic, consider the possibility you're on the wrong track, and consider the possibility that as the world shifts, maybe there's a better track to race on. And I don't know if this analogy works, but the point is we are already seeing in some of our portfolio companies that got a tremendous tailwind from COVID, saying, okay, that game is over, and now let's take advantage of what we acquired during that surge in terms of customers, in terms of technology, in terms of brand, in terms of reach, and let's figure out what's the next game. I hate to use the word pivot, but what assets do we have that can solve a big problem in this next world that we're about to enter that will enable us to continue the momentum rather than just sort of hunkering down within the business that we're in now. So again, it depends on the business you're in. It depends on the game you're in. Nuno's strategy may be exactly right in some cases.
No, but as most of the times we violently disagreed, Bill, we were actually in violent agreement, because I just mentioned that. I did say you can't just do the stuff that's tactical. You need to look at markets again. You need to look at strategy again. And if that market doesn't work, or if that market has changed, you need to reassess it, because it definitely has changed. So I am in total agreement with you. You might be playing in the wrong market and in the wrong track. Absolutely.
Right. And I think one thing that's pretty interesting is, on the VC side, a lot of our mojo and secret sauce is pattern matching, right? A lot of it is pattern matching against prior innovation cycles, prior recession cycles. I think the key piece, and this is getting a little deep on our side, but I really would push this to entrepreneurs, and this is a really key factor, is start to go back through prior recessions. And while Bill mentioned .com bust, there's the 2008 cycle, etc. I actually believe we're going even further back into the 1980s recession cycles, and being able to look at this combination of inflation, high interest rates, black swan spending issue, challenges, where you've got sort of an 80s cycle where the markets are soft, interest rates are high. These are all very interesting plays. And I think as an entrepreneur, you need to, there's enough data now available to you to step back and say, hey, let me go look at the early 80s or the late 80s and see how this cycle changed. Because one thing that is not going to happen is in the 2008 cycle, you had the American Recovery Act. The government slushed a lot of cash into the markets. Same thing happened again in the COVID crisis, thus creating this scenario, right? So what we're really looking at right now is a very different beast, right? The .com collapse had its own, sort of, framework, 2008, et cetera. But where does this going to match? What is this going to match? And I think we're starting to look back into the 80s and say, where is this going to make a difference, right? Where are the categories going to match against? And then I think you could look at it and I think, make some really good decisions. You could look at the companies that rose up, in the 80s cycles. There were Cisco's of the world that created greater efficiencies in the telco closets, right, of the world. There were some of the enterprise, the Oracles really changing the way enterprise software was done. So there is innovation room, it's just how you do it.
This has been a great panel discussion. We've got about 2 minutes left before we move to the Q&A. And Efrain, appreciate your advice to the entrepreneurs. Maybe Bill and Nunu, if there's any sort of parting wisdom you want to leave with the audience, I'll give you an opportunity to share that with them.
Yeah, I mean, I think we have been continuously in terms of offering, whether it's parting wisdom or I don't know, but in terms of this, I think we're all in pretty violent agreement around pay attention to tactics. We're also adding this added, overlay, which is consider strategy, consider, kind of how is the world changing? This is F's point. It's not the same world, and whether it's the 80s world or the .com world or the meltdown world, we don't exactly know, and almost certainly it's pieces of each, right? And so we know the world's changing, and so it's up to you in your business, in your market, with your target customer base and target sector and geography, to figure out where is opportunity that is evolving that you can take advantage of, and where is challenge that we need to anticipate and hunker down, or it's at least respond to. So it's gonna, each company has got to do a very, very, very serious soul searching in this context. And there's no, unfortunately, single magic recipe as to how to survive, or much less thrive. But I do think there's opportunity. My basic optimism is there's plenty of opportunity, not just to survive, but also to thrive by taking advantage of the shift in the market that will enable you to increase your momentum.
Fantastic. Nunu, did you have anything concrete or specific you want to share?
I
Otherwise,
do.
Yeah.
We've talked about a lot of things today. So I think just very importantly, figure out if you are the aggressor, if you're the Ayrton Senna that's going to pass the 15 guys, and how you're going to pass them, or if you are the Nunu and you're going to still be going through the corners at 1G, whatever, or 1 point something G, but like you just want to finish the race and not do anything stupid and just survive through this. I think the blocking and tackling goes without saying, but for me, that's the thing. Just figure out, where are you the aggressor or are you not? And most importantly, align with your core stakeholders, align with your board members, with your investors, that's the right way to go, okay? Because you might say, I'm the Ayrton Senna, and your investors like, you're not. You're just going to spin in the rain, right? So again, talk to your coaches. In this case, talk to your board members, talk to your investors, make sure that they've covered your back. They see the same thing you see, etc.
Yeah, find your allies, find your friends, build alliances. Yeah, I totally agree with Nuno on that. Yeah, talk. Make sure you know who your friends are, and engage them.
All right. Unless you have anything else to add, F, I was going to move to question section. All right.
Yeah.
Well, thank you, panel. This has been a fantastic discussion. It's not quite over yet. We've got our question and answer session. So for those of you who are viewing live, please use the Q&A function. We're happy to take your questions. We'll try and answer the ones that have the most general applicability. So please send them in. We've got a few. And to those folks who are asking, will I send them a recording? Yes. Again, so this is being recorded. And so long as you've registered, we'll send it to you in a few days, probably about a week or so. There's the holiday coming up, and you'll get a chance to watch this again. So with that in mind, maybe a softball question to Nunu. Question about why you have an office in Portugal, and tell us a little bit about what the venture ecosystem's like there.
Well, I'm Portuguese. Sorry, this goes without saying. I think that the two core things about having an office in Portugal is I have one of my partners is based in Europe and it just happens to be based in Portugal. And secondly, as I said and mentioned before, we were going to have a quant and tech team. And so we need to hire a lot of quant and engineering talent from Europe, right? Hiring in Silicon Valley would be impossible. I mean, just the salaries we would have to pay would be ridiculous. Hiring elsewhere in the US was a possibility, but then again, where we have the hub, and hiring in Europe, I think we were most comfortable in hiring in Portugal. I'm a computer engineer from a school in Portugal. I know the quality of the engineering in Portugal. The funny thing is we ended up with a team that is part Portuguese, but then it's part Eastern European. So we have a bunch of Polish people on the team. We just hired some from the Ukraine. I mean, so it's like we ended up sort of the two sides, like Portugal and Eastern Europe. And the also fascinating thing, which makes Portugal a great place to have a company in, is on top of having talent, of having people that really want to make stuff happen, having amazing weather and having amazing food and really nice people, right? And so all of that put together, what's happening right now is most of our team is moving from their home countries to Portugal, right? So we had someone from Poland move to Portugal. The person from Ukraine had just moved to the UK, just moved to Portugal. And so it just becomes a natural hub for people in Europe because it's, again, wonderful weather, people are nice, the food is amazing, and then you have great people that you work with. So that was basically the reasoning.
Fantastic. All right. So it looks like some of the viewers are interested in maybe talking a little bit more specifically about what we're seeing in sort of different, what's happening to valuations and the ability to get funding in different stages of a company's life cycle. So what are you all seeing at the sort of seed stage versus A stage versus B, C, and later in terms of making a little bit more concrete this bubble that's burst and how it's more difficult to get access to capital at this point?
Yeah, I mean, just again, we invest across the spectrum from seed through late stage. So we are looking, at everything across the spectrum. It's, nevertheless, it's still at the anecdotal level, right?
Sure.
I mean, we can't know globally what's happening. And actually, for any given entrepreneur, anecdotal is all that you really care about is your own particular anecdote. But absolutely, I mean, so there's no question, but at the top end, late stage end, and I think this was brought up before, just the flood of money that was coming into the unicorn part of the world definitely is being tamped down. And we're already seeing sort of revisions in fundraising plans in the middle of fundraising plans in terms of, saying accepting a lower amount at a lower price. There's a lot of resistance still for down rounds. I mean, entrepreneurs just, I don't know, invest, and I don't know that it's just the entrepreneurs. I think it's the prior investors as well that really, really make it hard for you to raise money at the right price if you're an entrepreneur. I got to tell you, entrepreneurs, if you can raise money but not at as high a price as your VCs would like you to raise money, you got to have that discussion and say, look, guys, a down round is better than no round. And so, but I do think it's as much the VCs as it is the entrepreneurs that make prices sticky on the way down, which is, it relates to the way the VC works. The seed stage, again, it's very anecdotal. I mean, it's hard for us to see yet whether it's any harder, because we were just seeing things all over the map from really easy to really hard at the seed stage for the last, several years. So it seems likely that it is going to be harder, but I think, again, it goes back to making sure you differentiate yourself from the rest of the pack.
Yeah, I mean, I think the angel and seed stage is going to be, very radically affected here within the next few months. I mean, the 401ks, the cash flow has still been flush out of the market boom here, right? Which, that market boom really ended in, the end of last year, Q1, right? So it takes about a year for people to kind of see less income coming in, see the return levels come in, and then start to get tight in their pocketbooks where, I mean, if you're a reasonable startup, you could find an angel group somewhere that would give you money in the last couple of years, is my opinion. There was just so much out there. I think that's going to be really tough for entrepreneurs. I think we're going to see much more of the more traditional company business building from entrepreneurs. The good part is a lot of entrepreneurs themselves have done fairly well, and we'll see a lot of self-funding, in my opinion, happen there as well. And to Bill's point, if you've got a term sheet on the table, take the deal. I mean, take a flat round right now because it's not getting any better, right? We've just, we've recommended that with some of our companies, just take a flat round right now, just put as much gas in the tank as you can, because on the back end, there are going to be half as many competitors or less out there. And that will actually help you. I mean, even a strategic down round that isn't too terrible today with some upside potential if you hit milestones. There's even the capacity at this point that, who will be standing in your space in 3 years is a very interesting conversation that you should be having. It shouldn't be your average competition slide. It should be who's going to be left. And I think that's really important.
Yeah, I would add that at this stage, it's going to be the haves and have-nots in a much more dramatic way. So don't think about it as a notion of, oh, I can't get funded because it's really bad. It's like if you're a great company, if you have great intrinsics, if you're at the right stage to get the funding, you can get funded at this stage as you did before. Maybe the valuation won't be as high as you wanted it to be, but you can. We're about to close 4 deals. If that sounds like a lot, it's a lot, right? We did 6 deals in our first 10 months of the fund, 6. And we're about to close 4 deals in a row in like the space of a couple of weeks, right? So there is money in the market. There are investors that want to deploy capital. The rules of the game have changed in terms of party rounds, will be more difficult to have at this stage. So again, the balance of power has changed back to us as investors. But at the end of the day, there are a great opportunities to raise right now. To F's point, if you have a term sheet, take it. We would have 5 deals at the table right now. For the first time in my career, I put forward a term sheet that I thought we had agreed to valuation and the core parts of the term sheet that really matter. And the guy was backing off on it. And then in the end, I was like, mate, I mean, take it or leave it. And the guy said, I leave it. I'm like, cool, fair enough. Good luck to you.
Yeah.
Right?
No,
And
that's
the sad thing about this, and I think that's the reason why it happened, is it's someone I've known for many years. And he co-founded another company I was involved in. Because I don't think if we knew each other so well, I don't think he would have pulled that off. And I think in some ways he thought, yeah, this guy's a nice guy. I'm like, no, I'm not. Because I don't trust you anymore, right? You just broke 9 years of trust, right? In me.
Well, and to
9
Bill's
years of
point,
trust. Just one moment.
To Bill's point, we should have this conversation a year from now with you, Nuno, and you can say, I had 4 deals in the pipe getting done on June 30th, 2022. What does June 30th, 2023 look like?
Of course, yeah.
I think, this, I'm not sure we're in a total dystopian post-apocalyptic valley yet, but I think it's going to, I think you're going to be like, maybe I'll do 1 deal and they're going to come with their hat in their hand and take whatever I give them, kind of thing.
Correct.
Interesting. Yeah.
So shifting a little bit to actually a more a fun focused question, I guess as we've got a question about in terms of capital deployment, has and earlier F, you mentioned basically extension of, 5-year extension to IPOs. I mean, has that sort of gotten built into the exit timelines or horizons at this point?
I mean, to a little bit, but you've got to remember the deal cycle, a lot of deals that are still getting done that the data is reporting on from Q2, those deals were in DD, they were really far along, many term sheets were down beforehand. In fact, what we have seen that isn't reported, and I think Nuno and Bill brought this up, is we have seen, a lag in the term sheet cycle. Term sheets that went down in December, January, even February have been retraded and renegotiated before they're closing. And that's, even to the point where Nuno said, like, VCs have said, forget my reputation. I'm going to pull this term sheet because I can't stomach it. Right. So we're seeing a lot of the overhang of that. I mean, I really think, and then the question is going to be, is August. That is really, to me, the definition of what's going to happen. I remember, and Bill remembers well, we remember that, and we actually were in the same deals. We were in one deal that blew up together in 2007. phone bites. Remember them, Bill?
Oh
You
my
know,
God. Wow, F. Wow.
yeah. And if
That's
they
amazing.
had salvaged their IP, Facebook would be paying you and I a healthy license
Yeah,
fee today.
I remember
So,
that.
I mean, things can happen at that point. So, I really think that August is the tell, right? If we're already hearing the hedgies, we're already hearing some of the private equity folks are just, they're taking off August. I was just in Manhattan where the family offices, the hedgies, the PE world rules the day. And, people were starting to exit the city. They're basically saying, I can take the next 60 days
Sure.
and not do anything fresh, and like after Labor Day start thinking about deals, right? The next 60 days are just about triage, making sure everybody's okay, but come Labor Day is when I'll look at anything fresh. And that to me is scary, because if August turns out like August 2007, it's going to be tough. If the VCs all escape, and no one returns calls in August, it'll be scary.
Well, and to the point about Europe takes the next 60 days off anyway, right? So, I mean, so Europe is in essence shut down for the next 60 days. So I guess just hold your breath and see what happens come September.
September, yeah.
Yeah.
That's spot on, actually.
Yeah,
Let's see
it's
what happens
after
in
Labor
September.
Day. What happens after Labor Day is just the whole, how does when the kids get back in school, how does the consumer, how does the average business, how does the small business, how are they looking at the world at that point? What happened in Ukraine, what's happened with interest rates? I mean, we've got, I don't know if my colleagues, I don't know if everybody caught this today on the clean tech side, EPA just lost its authority today. I mean, we've got some really, there's some, deep sea mines floating around out there that are going to pop between now and then. So, we think we're in the middle of a black swan event. I think there's a whole, gaggle of geese coming here, and we're not exactly sure when they're going to arrive.
Okay. Gaggle of geese. And I'm trying to keep the metaphor going here. So, okay. But yeah, no, it'll, so, okay, guys. Well, and then the other thing, nobody's said the word yet, but supply chain, right? And that is,
that's because there isn't a supply chain anymore, Bill. It's just so busted that there isn't one.
Yeah, no, I mean, and it'll be, we were actually on a call yesterday with a company that's, that is dependent upon China, interestingly, and their comment was that it looks like things are loosening up. There are a lot of people in the world who have got a very, very, very strong incentive to fix this problem. So maybe that will make a difference. Maybe things will get actually a little bit better rather than worse, at least in some of those dimensions.
That's a good point, Bill, actually, because one of the wild cards in this whole thing is China, right? Mm-hmm. The issue is, will they come in and prop up a lot of the US because, there's no buyers for their products, right? The problem that I think we've seen from China in the past is they're not truly benevolent partners, right? So this is a big wild card. This is very much a sleeping dragon right now. They've been kind of off the path because of their COVID wars for about the last 90 days, right? So, while Europe, I mean, and I'll tell you, I mean, Europe is, when I talk to my friends, my family offices in Europe, they're not happy people. I mean, Europe is scared, right? They, everybody I talk into Europe, France is not far enough from the Russian border for them. Okay. I mean, next stop, is pretty much the Canary Islands. There's nothing left between here and there, and they're scared. I mean, they're very concerned about, that. I mean, I think, things that are interesting is tech companies that are pivoting into the military industrial complex is actually super interesting right now. For us, and that's going to be a wild card. And to your point, Bill, supply chain, is key. One of the biggest buyers over the next, 36 months may be, the military side of world governments, and that's going to be super interesting on procurement.
Mm-hmm. And so I made the mistake of going into the chat box, which I shouldn't have had. And saw that people, there's a debate going on whether I'm a nice guy or not, whether they would partner with me or not, or whatever. So I do want to respond to the following. I have I have in my life invested in 50 companies, and I have 50 CEOs and founders that would vouch for me. Okay. I'm not a nice guy, as in I will cook for you, right? Maybe I will actually if I'm nice enough. I'm a nice guy in the sense that I'm very human in how I behave with my companies and how I work with them. But this is based on trust. It's based on the notion that we are business partners. We're not, we can be friends. I'm friends with many of the founders that I've invested in. I've become friends over time. Actually, the person that I just actually didn't invest in because they stepped back, I still consider him to be my friend, and he will continue to be my friend. But I will not invest in this company at this stage, right? So these are different things. We are in the business, as someone mentioned, the business of managing funds for our investors, our limited partners. That is number one priority. There's nothing else that's more important than that. That's the only right we have, okay? And you better believe that you want someone to be your partner as a venture capital firm, that when shit is gonna hit the fan, maybe a couple of months before, has that one-on-one with you saying, you're gonna have a huge problem and nobody's telling you this. That's the guy you wanna have on your side. Not the guy that's gonna tell you 2 months after it's gone to the shitter, right, that you're gonna die and they're not gonna give you more money. The partners you wanna have are not the cheerleaders. The partners you wanna have are the people you respect, the people that eventually become your coaches. That's it.
Yeah, and I'm going to add to that a little bit. I mean, VCs are, we're generally nice folk. And, and I think it's really important to understand that sometimes, we're very beholden to our LPs and more importantly, our placement agents and our accountants. And, until those, sort of shoes drop, if you will, we're going to be nice. And, I think what you have to understand is, we serve masters just like you serve masters out there as an entrepreneur, right? And when our masters come calling and they are unhappy with us, we're forced to make decisions that might not be 100% aligned with who we are as humans, but it all aligns. And that's why, I like to take it up this higher level. And earlier in the conversation, I was talking about the pressures that are going to be put on us on the venture side, because this is a Sun Tzu issue. Know your adversary, know your partner, right? As an entrepreneur, sitting back and blaming us and saying we're bad guys, no, that's shame on you, okay? Your answer is, let me understand the pressure we're under. Therefore, you will understand the pressure you're under. And those are the entrepreneurs that kill it. And, there are great friends out there. And, having a friend like Nuno is the greatest thing you can have as an entrepreneur, because he's one of the smartest guys I know, right? To even have the debate, says the world about you as an entrepreneur. So I will leave it at that. Whether you like him or not, doesn't matter. But the ultimate respect should be delivered, and, failure to do so just will predicate your future, in my opinion.
Yeah, just to chime in again, be clear. It's not about nice. It's about trust. And ultimately, if you fall out with your investors, I don't know where, it may be, the blame may be on either side, but if you fall out with your investors, it's on you to build the trust and build the confidence with your investors. And that was my point earlier. Where we sit right now, do not assume that they quote unquote have your back. You've got to reach out, engage with them, and make sure that you have their trust and that they and you have the same expectations about how this is going to play out. But too many entrepreneurs, I have discovered, are afraid to engage with their VCs, hoping that somehow things will get better, somehow they'll be able to fix it, somehow, there'll be some magic thing that happens. But, what destroys trust is if generally we get surprised in a negative way about something that you could have told us about earlier and we could have helped you with maybe. But,
yeah. I would add one piece to that, which is important, where the VC having your back thing is important. Even us on the VC side, while we may have had your back, when it comes down to it, we may have had, a lot of power taken from us. So while we do want to try and help you as best we can, when it comes down to it, you can't even be confident, even on follow-on allocations, that you're going to get it at the appropriate time. This could turn into a it turns into a survival issue for everyone. And as a VC, if you've got 10 companies in your portfolio, regardless how much you love the entrepreneur and you love what they're doing and everything else, you need to make survival decisions as a venture fund as well. So the entrepreneur needs to understand that, and they need to put themselves in the position that of the 10 companies in a VC's portfolio, it's a no-brainer to write them the check. You know what I mean?
Yeah.
And to Bill's point, transparency, 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 but also win, win, win. If you're not winning, be transparent, pull up stakes, move on. Because this isn't going to be, coming in the middle of the pack in a recession is just not going to, regardless how much we love you, is not going to get the next check.
There's a question that I'm getting more and more often, Neff, to your point, which from entrepreneurs, which is, do you guarantee follow on, right? Or do you guarantee that you're giving me capital? I said, I can't guarantee. And whoever's guaranteeing it to you is likely lying, right? Because again, a follow-on decision is still an investment decision. And guess what? Normally, it still goes to the investment committee and normally still needs to be voted for, right? So it is still an investment decision, right? And so again, someone who's saying, I guarantee, either maybe they're a single GP or there's some other conditions to their fund that are very special, but in general, most funds, they can't, right? They just can't guarantee it to you, right?
Yeah, and I'll leave the entrepreneurs with one key point, and I hope Nuno and Bill agree, which is, I think always in the Valley, we believe in the classic healthy paranoia term. It's always good as an entrepreneur to have healthy paranoia. I think at this point, it's good for an entrepreneur to have abject paranoia, right? Abject paranoia is the key, right? If you're expecting the absolute worst, it's all gravy. If you're preparing for, Armageddon, right, and the cockroaches crawl out, at least something's alive, right? So I think to a large degree, a CEO needs to be incredibly paranoid, incredibly careful. And those are the things that we as VCs like. I mean, I like, a generally paranoid CEO. Right now, I like a paranoid, crazy paranoid CEO that's like, wait a second, I can find credit lines at 11%. That sounds great because they're going to be at 17 in a year, right? So, making tough decisions early in this cycle, may help them survive.
Yeah, and almost every company in the last several years has gotten a little too fat and happy in terms of, headcount and spend. So many entrepreneurs in this cycle have never been through a down round. And they don't appreciate the importance of managing ahead of the curve in that regard. And again, every single down round, every single downturn that I've been through, the common refrain from every entrepreneur is, I didn't cut soon enough. That's universally that, and the other thing you hear all the time in downturns is, it turns out that I was actually more productive with fewer people than before I cut. That's something that I've heard a lot as well. And so guys, it's painful to cut. It is really painful. But consider where you are and what your runway is, and don't burn up all your runway cash and hope for a miracle at the end.
We had T-shirts in the 08, cut early, cut often T-shirts. That's where we're at right now. This is anything that's weighing down the ship goes over the side, right? And, I think I saw it in the chat, hiring that person back as a contractor at half the price in 6 months may be quite realistic.
Well, thank you, panel. We're almost out of time. And for the record, Nuno, I am very glad you were here. And I never thought that you were a pushover. So I'm sorry, I didn't read the chat. One panel, I got sucked into it and I couldn't get out of the chat. So
I will stop now. I figured out the option of not seeing the previews.
Yeah.
So I'm not.
It's okay. They usually hate me. They usually hate me in chat, right? I'm usually like the bad cop. So Nuno, just watching how even a
So today was me. Today was me.
Yeah.
I just,
Fair enough.
Yeah.
Fair enough.
but real quick, we did get one question, which
Oh,
should be maybe, I want to see if we can answer real quick.
1 second.
Does anyone know any books on how to be successful in Silicon Valley or might help you raise capital, Bill? Anyone who, we did get that and maybe you put it in the Q&A, I don't know, but I thought I'd make sure we ask it.
Yeah. Well, a friend of mine wrote a book on, how to make sure you articulate your compelling value proposition effectively. And it goes to all communications for all companies and all entrepreneurs. It's called Getting to Wow, Silicon Valley Pitch Secrets for Entrepreneurs. Getting to Wow. And the point of the book is, being in the middle of the pack, being good enough ain't good enough. You got to be the one that causes us to say, wow, that's amazing. So, but thank you for that opportunity, Jason.
Oh, my pleasure. And I think, Nuno, you mentioned your podcast earlier, but do you want to mention it again?
Yeah, it's in the notes, decipheredshow.com. And I do that with Bertrand Schmidt, who is the founder of App Annie.
I have nothing to sell. I'm sorry, guys. That's just
Sadly,
it.
I'm not selling anything
I'm a
either.
simple VC that just likes to raise money and give it to entrepreneurs.
Yes.
And that's it. That's all I do. I got nothing to sell here. I'm sorry.
Well, fantastic. All right, and that's time. Panel, it was a wonderful discussion today. Thank you so much,
you.
Nuno,
Great to be
Fram.
on it with you guys.
Thank you,
Bill,
guys.
Jason, great
Thank
talking
thank
all.
you, Rob,
Thank you,
and
Rob.
Idea.io for organizing, and thank
Thank
you
you
for
to the audience
attending.
for all the questions.
Yeah.
Cheers.
All right,
Bye-bye.
take care.
Thank you.
Bye-bye.
Take care. Be well.